We've extended our usual 7-minute time limit for a more in-depth introduction to spread trading. This course will share 6 points introducing futures spread trading. Number 1. What is spread trading? Number 2. What are the 2 types of spread trades? 3. How do you make or lose money in a spread trade? We'll take a little more time here referencing a price chart. Number 4. Spread trading reduces volatility and risk. 5. Spread trading reduces margin requirements. And finally, we'll look at the profit and loss profile of spread trading, which differs from standard futures trading. The first thing to know is, what exactly is spread trading? Spread trading is the simultaneous buying and selling of related futures contracts. So, for example, if you bought corn futures and at the same time sold wheat futures, you would have a spread trade. Each side of the trade is referred to as a leg of the trade. The 2 legs should be related. Corn and wheat are both agricultural products that meet that test. What if you bought corn and sold, for example, gold futures? The price relationship between the 2 legs is too distant to behave like a spread trade. Want a simple way to determine how closely related 2 futures contracts are expected to be? We'll show you when we get to point 5. Point number 2. There are 2 primary categories of spread trades. Inter-market spreads combine 2 different but related markets. The corn and wheat example we just looked at is an example of an inter-market spread trade. Other combinations of related futures markets could be the Canadian and Australian dollars, and the S&P and NASDAQ stock indexes. Intra-market spreads combine 2 futures contracts in the same market, but with different expiration months. If we buy the Japanese yen June contract and sell the Japanese yen September contract, we have an intra-market spread. For obvious reasons, this is also called a calendar spread. The earlier month is referred to as the front month, and later the back month. If you are buying the front month and selling the back month, that's called a bull spread. If we reverse this, selling the front month and buying the back month, we have a bear spread. Point number 3. How do you make or lose money in a spread trade? Let's look at an example. The price movement of the Fed funds contract is shown in blue, and the euro-dollar contract in gold. These are 2 short-term interest rate futures contracts, with closing prices shown for a period in 2016. If you're only buying or only selling, you obviously make or lose money based on the price performance of that one position. In this case, either the blue line or the gold line. With a spread trade, where you are buying one and selling the other, it is the relative performance between the 2 positions that determines the profit or loss. Let's take September 6th. The price of the Fed funds contract rose from 99.39 to 99.44, a change of 0.05. The euro-dollar moved up by 0.06. If you were trading either of these contracts independently, those price changes would determine your profit or loss for that day. If instead you had a spread trade with opposite positions in both contracts, your gain or loss for September 6th would be determined by the change in the spread between the 2 contract prices. For September 6th, Fed funds increased 5 cents and the euro-dollar increased 6 cents. The spread or difference between the 2 is 1 cent. This would be your spread gain or loss depending on which of the 2 contracts you were long and which you were short. Point number 4. Spread trades reduce volatility and risk. Let's look at the 2-year Treasury futures in March of 2017. The blue line shows the cumulative profit or loss from entering a short position on March 6th. Don't worry too much about the details, just focus on the concept of the chart lines. Few things jolt the interest rate markets more than a Federal Reserve interest rate change. What happened when the Fed raised rates on March 15th? On the day of the Fed announcement, you would have had a large loss. The next day delivered a partial rebound. Now, what if for that same time period, In addition to being short the 2-year June contract, you were also long the March contract, forming a calendar spread. The gold line shows the comparative result. On those two very volatile days, the 15th and the 16th, the gold line, representing the calendar spread, shows significantly less volatility than the blue single leg line. When external events move the market, both legs of a spread trade are often affected somewhat equally. Volatility and explosiveness are diminished compared to when you trade outright positions. This risk reduction leads to the 5th point, margin requirement reductions. Here is a screenshot from the CME Group website. This website allows you to search for the margin requirements of different spread combinations. We searched for margin requirements for inter-market spreads. We selected the combination of the Fed's fund and Eurodollar contracts. Note the contract ratio. The exchange's calculations show that to have good price movement offset, you need to have an uneven ratio of contracts. 3 Fed funds contracts for every 5 Eurodollar contracts. Side A and B indicate one position will be bought and the other will be sold. Next is the range of contract dates that apply to this margin requirement. For both legs, it is any contract month between April and June of 2017. The last column shows the margin credit, in this case 80%. Let's look at what this means in dollars. If we held 3 Fed funds contracts with a margin of $344 per contract, that would total about $1,000. Then there is the second leg of the trade. If we also held 5 Eurodollar contracts with a margin of $275 per contract, that would be an additional margin requirement of $1,375. Combined, this trade would require a margin deposit of about $2,400. However, when we apply the 80% credit, this reduces the margin for the entire package down to less than $500. Spread trading stretches your margin investment. Note in the second row that as the range of contract dates changes, so does the credit amount. It is educational to look at various contract combinations to see the degree of risk assigned to them by the exchange. Point number 6. The profit and loss profile of a spread trade is different than when you're just on one side of a trade. Let's visit an earlier chart. If you're trading only the Fed funds futures contract or only the Eurodollar's futures contract, your profit or loss will be determined by the respective price line. If you are buying one of these contracts and at the same time selling the other, it's the change in price differential that determines profit and loss. We've magnified the scale to show just the spread between the two contract prices. A technical trader might note that as the spread between the two contracts neared the 0.395 range, it hits resistance. And as it dropped to the 0.37 range, it hits support. This creates opportunities to grab small gains as the spread approaches either of these barriers and then reverses. Based on that pattern, October 13th looks like a chance to enter a spread, anticipating a reversal. October 14th moves lower, however. What do you do now? Well, this range has been so predictable, so you stay in the trade. The 15th extends the loss. The last 2 trading days may negate all of the previous small gains combined. This is a common pattern in spread trading, a series of small gains as 2 related markets move in somewhat tandem, followed by a bigger loss as an eventual unrelated movement occurs. Limiting losses is a cornerstone of all futures trading strategies. It's even more important in spread trading, where you are tempted to lower your guard as you get comforted by periods of relative predictability. To subscribe or watch another trading video, click below.